The final recessionary shoe has now fallen. Rapid interest rate spreads between the lower rates and the higher rates are indicating that either the recession is now imminent, I mean immediately imminent, or it may have already begun. And that's what we're going to look at today coming up. I'm Lynette Zhang, Chief Market Analyst here, and welcome to ITM Trading, a full-service physical gold and silver precious metals dealer specializing in creating strategies to help you through and possibly even making you better off on the other side of the reset that has already begun. But you know, look at the markets. They're all making these new highs. Wow, I think the S&P, this is the 7th high, 3 in a row. But even though the Trump trade war has now taken a little bit of a truce, nothing has really changed. So what's the news? Why are the markets going high? Because now, no news or bad news is good news. Basically, as the stock markets make new highs, you've got companies telling you that earnings are not going to be so great. This is brutal. What helped them last year was the change in the tax laws and the repatriation. They don't have that this year. So I'm wondering what's going to happen this next time. Because every time the Federal Reserve or the central banks globally have lowered their interest rates and printed more money, the impact of that has not been as great. It's been going down, down, and down. And so if this month they both do that and the markets do not respond in a positive way, because even these results lately, even with the new highs, they've been lackluster, well, that might be uncovering the truth. 80% of the stock market is on autopilot because since 2008, passive investing has grown. So that ETF market, frankly, and I'm going to repeat this, has not yet been tested in a crisis. But you've got a full 20% of those ETFs that are just about following the trend. So on the way up, it'll push the market up more, and on the way down, you could see a liquidity crisis, and also you could see liquidity absolutely dry up. That means that when you want to sell, you're not going to be able to because there's nobody on the other side to buy that trade. We've been talking about yield curve inversion really since I noticed it December 4th of 2018. And for people that are new to this, what a yield curve inversion means is that shorter term interest rates are paying you more than longer term interest rates. And in fact, as of this morning, before I came into the office, the 10-year treasury, so loaning somebody money for 10 years, was at 1.938 or something like that, where the overnight rate, loaning the Fed money overnight, was at 2.38. So if you just loan money overnight, you're going to make more than if you loan it out for 10 years. That's insanity, but it signals that a recession is near. Now, what makes it imminent is that now the difference between the higher yield and the lower yield is widening. And you can see that right here because this blue line is the 30-year bond. And the 3-year and the 5-year bills and notes, you can see how wide that spread is. This is where it was in September, okay? And then it started to shift, and you can see how wide that's getting. And the speed that this is happening is now escalating. And according to Societe Generale, which is a bank, one of their market analysts, that this suggests that the recession may even have started already. And we know that because why are the markets making new highs? Because global central banks are dropping interest rates more. Who does that really help? Does that really help you? No. All that does is position more debt to push the stock market up. That's what it does. Valuations don't matter anymore. This is all typical before a crash. The recent breakout in spot gold, which is a Wall Street product, it doesn't reflect gold's true fundamental value. So a lot of people are asking me, well, it's going up and down and, can it go down again? I want just to kind of talk a little bit more about the support and the resistance level so that independent of what anybody says. But you see how I drew this line all the way across, and it hit it here, it hit it here, it hit it here. Okay, and then it finally broke out there. Because once a resistance level is broken, it then becomes a support level. In other words, the lowest that this is likely to go is 1350. That's the lowest that spot is most likely to go now. When I'm looking at where support and resistance level is, once we break above that 1550, I really don't see very much, do you? I don't see very much that would be in the way of spot gold ultimately concluding the long-term cup formation that it started back in 2011. This is a long-term trend. Short-term, anything can happen. Nothing really does go straight up. Nothing goes straight down. You always have to have some bouncing along the way to shake out traders. I am not a trader. I do not buy gold or silver for that matter to sell it for more fiat money because I don't really care about that. I understand money. I look at its value, and I know that the risk level right now it's certainly as extreme as I've ever seen it, and then some actually. What happens when they're beaten and they're bloody and they're bruised enough, and then they see the prices for everything in terms of that fiat go up rapidly? All confidence is lost. That's what gold is telling us, spot gold. And what silver's really still continuing to do, because everybody's asking me about it, is it's continuing to build that cup base. But in silver, from a purely technical basis, I see resistance at 1620. So the cup, the foundation is still in. We're not on the upside of it yet, but we could be. I mean, we've had a lower low here in 2016 than over here, but I need a little more time to pass, and we'll look at this graph again and we'll see where it goes in the future. I can tell you, even though we're still building that foundation, all gaps ultimately get filled. And I see two gaps in silver. I see one up here that should take spot silver about 26 bucks an ounce. And then I see the other one right up here at around 40 bucks an ounce. The system is broken. I'm prepared to put my technical neck on the line right now and tell you that the debt bubble is popping now. No longer is there just a pinprick in it, which is what's been. So they could keep filling it up with new easy money. The hole is too big now, and they know it's not going to work anymore. Get it done. Please, please, please get it done. I keep saying I'd like to do some fluffy pieces because I feel like I've done some, so many heavy pieces, but a lot of things are changing right now. Do not be fooled by their perception management. Do not be fooled. You do whatever you want, but any wealth that you either choose to or have to keep inside of these fiat markets, make sure you have wealth insurance. And the only way to do that is with physical gold and silver outside of the financial system. Financial shields are made of physical gold and silver. Definitely not contracts or paper or promises or anything else. You gotta have it in your possession. And it needs to be close enough to you that you can actually utilize it. Because I do know that some people think that they can store it someplace and it'll be safe. But when we're inside of hyperinflation, how are you going to go get it if it's not close enough for you to walk to? That's how I hold mine. I don't hold it in my house for obvious reasons. I'm so visible. But who even thinks that anybody has gold and silver? They don't. That's not a normal thing. And that's to our advantage. But there are lots of private vaults, which is where I hold mine, in a private vault that is secured. And if you have any questions, give us just send them in to questions@itmtrading.com. If you like this, give us a thumbs up, subscribe, and hit that little bell, and then we'll let you know when we're going on live because we love the questions afterwards. And until next week, we'll see.